First of all, what the heck is tax loss harvesting? It's sort of like farming for losses, if you will, in your portfolio. Let's say you have capital gains throughout the year, and now you're looking for ways to offset perhaps some of that gain that you might incur on your tax return. Well, tax loss harvesting is one way to do that. And you do that by looking at the securities that you hold, determining if you have any unrealized losses in those, and making strategic selections on what you may want to sell and what you may want to hold. And selling those ones with losses you can use to offset those with gains. So it's sort of like, as you get closer to the end of the year, typically a lot of this happens in December because you have at least 11 months in, so you sort of know what you're looking at. As you have, depending on how many gains you have, sort of farming for these losses, if you will, to determine how much you may want to offset from a capital gain standpoint can help. One thing to remember too is that to the extent you have losses that exceed your gains, that exceed $3,000, you can't take more than that from a loss standpoint. So if you have capital gains of, let's say, $10,000 and you generate capital losses of, say, $16,000, you can't take a $6,000 loss in excess of that. You can only take 3 of that, and then the remaining 3 basically gets carried over into future years. So just be mindful of that as well as you're looking at your portfolio. And finally, if you like the securities that you're selling, be mindful of what's called the wash sale rule. The wash sale rule basically means that if you sell a security at a loss and you buy it back within 30 days, that loss is disallowed. So just be mindful of that as you're making your stock selection. Let's talk about year-end charitable contributions, in particular using donor-advised funds as a method to do that. A donor-advised fund is a way you can think of it like bunching your charitable contributions into one given year. So if I have a big year, let's say from an income standpoint this year, but my income is not going to be so high next year. So this year I may be in the highest bracket. Next year I'm going to be in a lower tax bracket. One thing you might want to consider is, if you're charitably inclined, is using a donor-advised fund to sort of accelerate some of those charitable contributions. So I might take, let's say, some of my stock portfolio using low basis stock. That way I don't have to incur the gain. When I'm not going to be selling the stock, I'm going to be donating the stock. I get a tax deduction for the fair market value of the stock. So whatever the value is on that particular date, it goes into the fund, and then the fund will distribute to the charity sort of upon your discretion over the next several years. So you don't have to give it all to the charity at one point, but I get to take the entire deduction today. So that's one really big benefit of using a donor advised fund. But, I typically like to recommend that you use those in a year where you have higher income, so you can bunch them all into one year, and then you can distribute to the charity over a period of years if you like. So, the charity still makes out great, and you make out great because you get to accelerate some of these write-offs. And again, I like using stock for this, low basis stock rather than cash, because, if you have stock that you bought at $10, now it's worth $100, you give that stock to the donor advised fund, well, you get a tax deduction for $100 in that particular example, assuming it's all long-term. You've held it for more than a year. So just be mindful of that as you're making those selections. And, it's a great tool to use towards the end of the year. $529 plans under the Internal Revenue Code, that's what they stand for, Internal Revenue Code 529, is basically a way where you can fund, let's say, a child's education using tax-free earnings on that by contributing to a 529 plan. Now, here's basically how they work. States generally set up 529 plans. In Connecticut, for example, it's under the Connecticut Higher Education Trust. You can find that at aboutchet.com. You fund the 529 plans. From a federal standpoint, there's no tax deduction for that, but what does happen is the earnings, the interest, dividends, whatever it might be within the fund that grows over time, that grows completely tax-free. So when it's pulled out at time of education, all the earnings are completely tax-free. So it's a great vehicle to use for grandparents, parents, great way to sort of juice the child's education fund using tax-free dollars. One other method that a lot of people forget about, which is becoming more common, is many state programs allow for a tax deduction by doing the 529 plan. So if you contribute to their 529 plan, you're allowed a state tax deduction. Again, not a federal, but you do get a state tax deduction. So you're picking up a state tax deduction for the amount of the contribution into the fund. And plus you win by making, all the earnings will be tax-free once they go to pay for the child's education. So look into that for your state. Around here, Connecticut does it, New York does it. A lot of states are starting to do it, but it's a great year-end vehicle to do some of that. A Roth conversion is basically taking what's called a traditional IRA, meaning, let's say I'm working, I decide to put money into an individual retirement account. I pick up a tax deduction for that. And then later on, I want to convert that into what's called a Roth IRA. A Roth IRA works independently from a traditional IRA. If I were to contribute to a Roth IRA, I basically, again, I'm working. I put money into a Roth IRA. I do not get a tax deduction for that. But what happens is the earnings over time, when I go to pull it out at retirement, they're completely tax-free. The difference in a traditional IRA is I put the money in, I get a tax deduction today, and then the earnings are taxable upon my retirement. Sometimes, depending on your situation, every situation is completely different. So consult your CPA. But sometimes, depending on your situation, it makes sense to take the IRA money, the traditional IRA that you've been contributing to, and converting that to a Roth. Well, upon conversion, what happens is that money becomes taxable upon the date of conversion. So sometimes it's better for like a young person to do that, or if you're having a down year from an income tax standpoint, or you have business losses I can use to offset the taxable amount of the conversion. But that's why at the end of the year, you sort of look at things like that. Like, what's my income look like? How old am I? Does it make sense for me to do that? And it doesn't always make sense, but sometimes it does. So as you're looking at it from a year-end standpoint, consider Roth conversions as you make those determinations to see if it makes sense to actually accelerate the income tax on the conversion so that you get tax-free earnings later. Again, doesn't always make sense, but consult your advisor for that.